Mm-hmm. Okay, we can start. So the last session, we looked at the debt schedule, how to develop it, We looked at two methods. The first one, it was a bit complex, maybe. We had to go a bit manual. That was the first method where we're actually using this formula up here. Then we said life is always easy. Don't go for the hardest method. Then we looked at a much simpler way of actually developing or modeling debt. We recognize the fact that Excel has so many functions, and whatever we're doing using a mechanical method could actually be done easily using the Excel inbuilt functions. So we looked at the PMT, which basically looks at debt servicing, meaning it picks the output is principal and interest. We also looked at the PPMT, which gives you an output of principal. Lastly, we looked at the IPMT, which is basically interest. So today we'll not waste much time. We'll then look at the balance sheet. Maybe this one first, I should show that this is an income statement. If you want to be a bit fancier, no time for fanciness. Okay. So let's pick the debts. Copy is Control C, you know that. You go down just after net income, I think in line 47. Paste, which is Control V. So go to D47. Change what is in D47. Pick C3. So in here, just type equals C3. Matthews, are we together?
Yes, Director, I'm following.
Sure, thank you. Okay, so in B45, I wanted to be a bit fancy. I wanted to go to insert. But like I said, there's no need for fanciness. Sorry. And pick what I want to pick. What I wanted to pick. Okay, just type balance sheet. Oh, okay, I can pick that. I can go to where the art. If I wanted to be a bit fancy, pick this, type in here. 。   . 。  . 。 . 。 . . . . . . . . . . . . . . . . . . . . . . . . . 。 . . . . . . . . . . . 。 . 。 . . . . . . . 。 . . balance sheet. Select the object, go to home, change to
Doc,
20.
Director, just a second from my end.
Mhm.
How did you copy the first data which is on top? When I copy what I'm getting in my year one, I'm getting weird numbers. How did you copy it?
So just go in the second column. Just check where my cursor is. And in there, just type equals C3. Your dates, they'll be reset to no mercy. Have you managed?
Thank you, I've managed.
Okay. So I was just trying to show you how to pick this from the way that you can decide which one you want. Just go straight to insert. You go to word art. Check if you want to pick this. Yes, Martin.
Just on that, because I also got some weird dates here. So how do I restore those?
Yeah, like we said, you see where my cursor is? The cell that I'm in.
Yes.
Yeah, just type
Yes,
equals.
I can see.
Yeah, so just type equals P3.
Equals P3 or basically, okay.
C3.
Okay, so equals C3.
Equals C3.
Okay,
C3. Martin,
C3
are
equals
you
C3.
okay?
Yeah, okay, yeah. So I think so then I copy the C3 across
I can't get you.
so that equals C3. Then I copy the C3 across
No. Just type
the
equals
timeline,
C3
right?
and press enter. It should be okay.
Okay, so sorry, equals C3.
C3.
C3. And I enter. Okay. I think I
The
should be fine. I
problem.
should find that. Yeah.
You have managed D.
Yes. I've managed. Actually, I've managed.
Okay, thank you.
Direct.
Yeah.
Yes.
So we have balance sheet here. I was just trying to show you that you can use word art to make your model look a bit fancy. Okay. So under the balance sheet, we'll start with cash. Type cash. Let's create the template first. Type receivables. You can type other current assets. You can type fixed assets. Then you have total assets there. You go to 59, you can type other current liabilities. You can type debt. You can type equity. And down there, you have total debt or liabilities and equity. Okay, just move fast. If you want, instead of just having other current liabilities, debt and equity, under equity, this is where you also have retained earnings. So you can leave it like that. Are you done?
I think we are okay. We can move.
Okay. Okay. So highlight up to year 25, like this. Press Control 1 and go to border. Go to border, you have that. You have that. Pick this. So let's do the same with cash flows. First, we just create a template that we can move very fast. Copy that object and paste it here in 68. Edit and call it cash flow. Hmm. So copy the dates. Copy the dates. Control C. Go down there in 71 and paste Control V. Do not worry with the dates, they have come out. Just go in the D71 and type equals C3. So go to copy the dates and paste in line 71. Then change whatever is in D71, change it to C3. Okay. Okay, so let's get back to the balance sheet. I explain what this balance sheet is. I explain what the balance sheet is to the non-finance gurus or managers. When you look at the balance sheet, you should always think of the two things. You should always think of two things. That is the eyes and the ears. That is what the balance sheet is. The eyes, these are the things that you can see and feel. Those are assets. At least we know that Professor Chembe has a limousine and a Lamborghini at home. And we are able to see those. But then, liabilities and equity, they are things we hear. And sometimes when we do not have evidence of how those things were acquired, the things that we see, where I come from, in the village, since I'm a village person, they'll just say, Mulohi, he's a witch. He's a Satanist. Or they'll say, those things you see, he got a loan. Or it was a combination of a loan from Absa, and he also managed to sell a bit of his cattle or steers to justify what is under assets. Because assets, to create assets, they'll be either funded by debt or equity or a combination of the two. Usually, if you have assets, which is basically things people are able to see, and they cannot connect to how you acquired them, there'll be two things. It is either you're very corrupt, that you manage to acquire these assets through your corrupt activities, or you went to sell some years in some country and you managed to get these assets. And this is what I'm saying, that assets and liabilities, when you look at them, always know that assets is basically the eyes, and equity and liabilities is basically the ears. And at any given time, they have to balance. This is why it is called the balance sheet. But for those that are accountants, for some reason, they found a very bad name. They are now calling it statement of financial position. But in project financing, we have continued calling a balance sheet because it's basically a list of assets, equity, and liabilities. It's basically a list of assets, and they have to be generated or funded by equity and liabilities. And that is how assets are created. And life, this is how it is anyway. When you look at money, money is a function. It's a KPI for productivity. So there's no way you can have money which is not linked to productivity. It's not possible. But usually people have money and you cannot link it to productivity because money is a KPI. It's not papers. It's a principle that is driven by productivity. Now that we are done with the balance sheet, I just wanted to explain. We'll go to the cash flow statement, but get to know one thing, that organizations, regardless of the size, it could be a small cantemba that we are running, or it could be a company that is actually on the New York Stock Exchange, there will always be 3 decisions that have to be made. And these 3 decisions, these are also the same decisions that you make in running a home, because a home is an organization. You have maybe a husband is a CEO in that home. You as a wife, maybe are a chairperson. Children are part of the board, but there will always be 3 decisions that you have to make to grow your assets and still make a return as a family. And this is how organizations work. You have to make decisions that are around or supporting your sustenance at home. Those are the decisions that you make. You're buying mealie meal, you're buying cooking oil, or as we call it, salad and stew salad. You buy cooking oil, buy the groceries and all these other things. That is basically your OPEX. So you have to make a decision on your OPEX. And your cash flow statement will have the first section. It is basically on operating activities. How do you operate your home? How do you sustain your home? Even before you start thinking of other things, you first need to think of how you're going to survive. So even when you come up with this SPV that is generating, or you're able to produce power or electricity and selling to an off-taker like ZESCO, the first thing that you have to do is to manage your O&M, operations and maintenance. And even on the pecking order, the lenders or the owners of financing, of the finances that you use to create this asset, they know in the pecking order that they come second. After O&M. And this is why they insist that the O&M, especially on the maintenance, there must be contracts, a contract with a maintenance or supplier that is able to do that. Sham, switch off. Sham.
Director, I think we have Engineer Simukoko and also Stephen there. We can hear the shoo in the background. Can they mute themselves? I've already posted in the group to say, as you join, please mute yourselves.
So this is why you have that operations. That's the first part. Once you sustain yourself, you can even think of now growing. How do you grow? This is why you start talking about investments. Because from your operations, you have either a deficit or a surplus. After you have bought Unga, you have bought all these other things. Now, this is where your dreams come in, because for you to continue supporting your operations, you have to start thinking of expanding your revenue base. And this is where you start thinking of assets. So it's investments. No, you want to start a farm, or you want to build a house. But the money that you have generated from possibly your salary, it cannot manage after you have paid your operations, or you've covered your operations, you remain with 0. Maybe this is where now you start thinking of Tizapanga Branch in Dalam, how are we going to make money? So that we start building. So the third component is, how do you finance your investment activities? So we will go to the cash flow statement. We'll start with cash flow from operations. The CFO. Underline that. So under cash flow from operations, you have all the elements that are in the income statement. Those are the things that then now you factor, because you assume that you'll be able to generate value from your day-to-day operations of your company or your SPV. So in this case, we'll start with net income. You add back, and I'll explain that, add back interest. Once we are done, I'll explain. Add back depreciation as well. Or let me just type and say depreciation. I'll explain what this thing is. Changes in receivables. Changes in other current assets. Change in other current liabilities. So this is change in receivables. Change in other current liabilities. Change in other current change in other current assets, change in other current liabilities. Okay. So I'll pick this. So this is basically your CFO, your cash flow from operating activities. This is the first part of your cash flow statement. The other part now is on investments, which is a CFI. You can go to line 88. Say investing cash flow. Maybe we say investing cash flow, which is CFI. Underline. Here, when you're looking at solar, hydro, whatever it is, it's mostly a one-liner. You have CapEx. which is basically your capital expenditure. Do that, which is in CFI. Then down here, in line 99, there now to be cash flow from financing. Underline. No. So under financing, you have debt. You have debt repayment.
I don't know if it's direct. I don't know if it's just me, but we lost you briefly.
So someone was trying to call on a normal line, and
Okay,
it
okay.
disturbed the network. So you have debt repayment, you have interest, you have drawdowns. So these drawdowns, it is both equity and debt. So they come in as cash inflows. Then you have dividends. Down there, you have cash flow from financing. I would have left it as a CFI, but it won't make sense. So I'll send cash flow from financing. Then down here, you have change in cash. You have cash beginning. And cash ending, end of year. Okay. So we have the template. We can then not just start filling it in. So we'll start with the cash flow statement. Fill it in. And go to the balance sheet. Fill whatever is in the balance sheet. So the net income, you know where to get your net income. Up there, what you're calling as net profit or net income. Yeah.
Long time. Not bad.
Mute. So you have net income. Then we have to add interest. Mute.
James Tonya, you can mute your mic.
Interest. Don't worry, I showed you how to do this. Don't do that. Don't do it. Just leave it as is. Just used.
Director, I'm a bit lost.
Yeah, I'm saying don't do what I was doing. Just leave them as zeros.
I'm going back to net income. On net income, where did you copy that from?
It picked from the income statement. What is your net profit or net loss, whatever, but just the net income.
All right. Yeah, because I think is it the...
It's
the
under
last number
42.
in your income statement.
Under
We
42.
also called it net income. Yeah.
Okay, yeah, because when I copy it, I'm seeing a value, but on your... Here it's coming as a 0.
In 2026, you were still constructing.
Oh, okay. No, I get it. Thank you.
Then we pick depreciation. So we'll then look at in the assumptions. I guess we never included elements, working capital elements. I think we'll need to do that. We'll have to show the changes in receivables or the assumption on receivables. How many days are we going to be taking? On payables, like liabilities, how many days? So we'll have to show that.
Okay. Have you hired you guys?
Mute.
Huh?
Mute.
What's two?
Mr. Munari, can you mute yourself? Director, maybe you can put me as a co-host so that those who are not muting, I can mute them.
How do I even do it? First, let me pause. Okay, so we'll go to the input sheet and create assumptions on receivables, other current assets, and the current liabilities. So under this, go to line 78. 79, sorry. Copy that. Let's come here. Control V. Change this to 8. Here we can say working capital. So under working capital, we have receivables days. Or say receivables. We'll create an assumption. We have other current liability assets. And we have other current liabilities. Okay. Okay. So on current liabilities, here we look at the days. Days as well. Days as well. So with receivables, we are saying our policy, whoever owes us has to be able to pay within, let's say, 30 days. Let's say 30 days. Other current days, or these are form of receivables as well. Let's say maybe 10 days. Current liabilities, let's put it at for 5 days. This is basically liquidity engineering, where whoever you owe, ensure that you take a little bit longer to pay than you paying whoever you owe. I haven't said it right. The people that owe you money, they should actually pay you before you pay the people you owe. That's liquidity engineering. So we have receivable days. We are saying at least a year should take 30 days to receive cash from people that owe you, because you're selling this power. So you're assuming that in this case, it will be the off-taker, who in this case may be ZESCO or any other off-taker or firm. So they should be able to pay you within 30 days. For those that you owe, you're saying you take a little bit longer, which is 45 days. Use their money to generate wealth. Okay, so we have included this part. So then how do we compute the receivables? So I'll go up here. Go to the balance sheet. Under receivables. So the formula would be, for you to find your receivables. If your receivables, we are saying is 30 days, meaning it will be 30 over 365 times your revenue. Because here you're saying, if you have revenue, say 1,000, that is what it's showing per year. It is per year is 365 days. So you're saying in 30 days, 30 of 365 revenue will be receivables. That is what they will be owing you. So meaning you have 1,000, which is basically your sales times your days, which is basically your 30 days. Your 30 days divide by your, but in days as well, which is your 365. So this is how we'll be able to get the receivables. So it's sales times 30 divided by 365. Yes. So let's start. So we go in there, we say equals, we pick revenue in the income statement, your total revenue, which is here. Times your 30 days from your input sheet, go to the input sheet, pick that 13, which is in D88, please lock it so that it doesn't move. Close and divide by 365. Best practice that 365 as well should have been in the input sheet. But no harm, we'll hard code it for now. So all you're saying is your sales times the days, the receivables days, divide by 365. It should be able to give you the receivables. So if I take it this side, up to there, Control R. So these are the receivables that we have. So under the other current assets, we'll do the same, which will be basically sales times 10 days. Usually on other current assets, even 10 days is too much. We'll put 2. Just small things that they owe you, or that owe you, which is outside your principal activities, which is outside the sale of your electrons. So there could be certain things in business that people owe you, not necessarily that they have bought electrons from you and they have failed to pay. No. Or they have bought on credit. There could be certain elements in your business that people owe you, but it's not coming from your receivables. Similarly, for us who work, there could be people who are owing you. I want to say the company, maybe the company owes you. Owes you, and this could be possibly per diem, subsistence, which is outside your salary. And it should be a very small element anyway. So on the other receivables, to be the same thing here, it will be equals C22. I hope it is. What was? Yeah, C22 equals, open bracket, C22 times, you go to the input worksheet, you pick D89, lock it. Plus divide by 365. Enter. Okay. Get this side. Let's control R. These are your other current assets. Go to other current liabilities up there. Under other current liabilities, do the same. But current, your receivables, people owe you. It is because you are selling electrons and the off-taker is not paying you on time and not paying possibly 100% of the invoice value. Then you start generating what you call receivables. For current liabilities, it is basically your purchases, whatever you're purchasing. And again in here, you don't expect a big number for your current liabilities. It is usually smaller. I know I've put for 5 days, but it is usually smaller. Because you are the one who is actually generating this power. If you were an intermediary, maybe a power trader, meaning that you are buying power from somewhere and you are selling it to the ultimate off-taker, the story to be different. But here you are the one who is actually generating power. So I don't see on how you can go to for 5 days. Let's actually put 2 maybe, or 1. Yeah, let's put 1. So under current liabilities, here we'll actually check on the cost of sales. On the cost of sales. Yes, Salim, you'll be changing, you can change it from 45 days to 2 days, the other side. It's fine. It's very, very okay. So under other current liabilities, you say equals, open bracket. Let's just check on the expenses. Because here, maybe to be on issues of these maintenance, insurance, property rates, other going costs, to be a smaller component on your OPEX, which is C30. times, you go to the input sheet, you pick other current liabilities, which is under line 90, log, divide by 365. So Salim, we'll check on the sample. You can send it to Professor, and they'll be able to share just a sample. The tariff there will be XX, no company name. Professor Chen will be able to share. He has the template.
Noted.
Sure, thank you. Okay. So we'll pick this. Control R. So we go to the balance sheet. Under the balance sheet, we have to add equals sum. Start from here. Pick all these plus cash. Enter. And take it this side. Control R. We remove those telephone numbers. Okay. So we can find the fixed assets. We have workings here. We have the depreciation. So this will be our fixed assets. In year 0 or in 2026, our CapEx level was 36,950. By the end of year 25, it was 0. We fully sweated the asset. So we go to financial projections and assets equals. Go to the input, not the input, sorry, the workings. Pick C17. Pick that. And take it all the way in. Control R. Okay. We're almost there. Save. Okay. I think down here, let's include another row. Can insert. Maybe we call it retained earnings. Retained earnings. So I didn't want to have that part. But just for now, then we can model dividends later. Mm. So we have the debt schedule here. We have these balances. Mhm. This is from year 2027 as the beginning balance before your depreciation or before your amortization of debt. But then you have these numbers and it shows your debt levels up to the time that it is fully amortized. Mhm. Okay. So we go to the financial. So we have our current liabilities. I'll go for the low hanging fruits, which is the retained earnings. So the retained earnings, ideally, it is basically the accumulation of your profits and losses from the income statement. Mhm. So here to be equals sum, then bracket, go straight to the net income here, then press full colon. It will automatically, if you're not using a MacBook, the moment you put full colon, it will repeat what you had. That's C42, be like this. So what we are going to do, we'll lock C42. Press enter. We'll modify later when we then now model dividends. Because dividends ideally is, the way it is modeled, it is the minimum of cash balance and retained earnings. Any of the two that is lower, that is what it picks as dividends. That is how they do it in bankable financial models. So retained earnings, for now, this is how we'll do it. To be like this, but it looks awkward because most of these elements here to be basically part of your dividends. Mhm. Looks weird. Yeah. Mhm. We continue. Like I said, this is just temporal on retained earnings. We'll still remodify this part. Okay. Cash comes from the cash flow statement, so you leave it as is for now. Then we come to debt. Mm-hmm. Okay. So go to the cash flow statement. We'll be juggling between the balance sheet and the cash flow statement. You come to change in receivables. This is in year 2026. You do not expect anything in there. Maybe first, let's pick these three. Go up to 2051, control R. So receivables to be 0 here, 0 there, and 0 here. Now we'll start calculating from computing the receivables. Change in receivables in 2027. An increase in the receivables is a cash outflow, because the people that owe you, they are not giving you. So as long as you're increasing on receivables, that increase is a cash outflow. A decrease in receivables is a cash inflow. So start to be equals. Go to the balance sheet under receivables. So you can see that receivables increased from 0 to 732. This actually means that it is a cash outflow, it's a negative. So you pick the first one, column C, minus column D, so that it gives you a negative. As long as you're increasing on receivables, it means that you are losing money. Do that. That would be the same thing with current assets, control D. Please try to center this. I'm sure you'll face such a scenario where you're trying to center and you can't center. For those that work in finance department, and you do with the numbers. Excel is very funny. You're trying to center, you can't center. And you have numbers that look like this. The best way to center this is to remove the X, the stars, from your formula, from your format. So you go to custom format, which is you press Control-1, you go to custom format. You see these negative, these stars. These are the ones that actually make you not format the numbers in the manner that you want to format them. So you have to remove them. No big deal, you just remove them. Remove them. Then you can press OK, and your problem is done instantly. Hi. On current liabilities, the movement will be different. An increase in current liabilities is a cash inflow. So in this case, to be equals, you go to your current liabilities. This minus C59 and press enter. The same things, the format issue, pick it there. So I can then copy to the right, which is Control R. So we have these numbers. So sum. The first part of the cash flow statement. Are we there? You seem to be.
No, we are following, Director. We are
Okay,
okay.
that's
Yes,
good.
Director.
Okay, that is good. Yeah. So we are done with the first part of the cash flow statement. So we then look at what has been invested under CapEx. So that investment, it is obviously the total CapEx. I think the total CapEx was 36. So say equals minus, because it is an outflow. Go to the input. You'll find it somewhere. Which is this one here. Usually we model the cash flow schedule, the CapEx schedule, but in this case, we can leave it like that. It's fine. Which is these numbers here. For R. On debt repayment, you started paying debt in year 1 after COD. So the first part on debt repayment and interest, here you have zeros. So debt repayment, you already have the numbers in here, which is this, the principal there, how many? They are 15. So you can come here under debt repayment. You can count for 15, 15, 15. I can count 15 cells. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So if I wanted under debt schedule, I would have transposed them, transport the prepayments and principal in that worksheet, but it's going to take long. Excel has an array formula or function called transpose, and this is what we're going to use. For those that do not have the latest Office, I'll show you how you do it. So to be equals transpose. Then you go to date schedule. You find the principal payments here. Push a minus. Once you transpose like this, for those that do not have the latest Excel, they've changed these array formulas. Those days we used to hold we used to call it CSE. Control, you hold shift, and press enter at the same time. And press enter at the same time. But for those that have latest Office like mine, you just equals, you highlight what you want to transpose, and just press enter without holding the control shift and enter key. And you see that you have some carry brackets here, like the one that is next to P on your keyboard. Those are the ones that you're going to have, not like this. So we have the debt repayment. We'll do the same on interest. You seem to have started losing interest in everything, right?
Oh, we are
Director, what do
following
you mean?
the director.
Okay. You see, you have interest in everything.
No, we are following.
These are everything,
We are following the director.
Okay, thank you. Because minus.
We are still on 8th, Director.
Okay. That you have started losing interest. Transpose. Then go to debt schedule. Pick your interest here. Close. For like those that do not have the latest Office, you hold the control shift and press enter, CSE. Control shift, then press enter key. Yeah. So your drawdowns, which will be your to the positive number. Here we are actually assuming that your drawdowns you had the maybe a bullet payment or within a year, because construction period is a year. So we are not complicating things. If the drawdowns were done, say 3 for 4 years, especially for power stations that take long to build, you will show that CapEx, which is your 36,950, and it will actually come in portions. But in this case, we'll just pick what is in the input sheet, your drawdowns, your capex. This will be basically your drawdown. Okay. Leave dividends for now. Just want to make it much easier. And sum, for sum, pick these numbers up to dividends, press enter, and take it this side. Control around. Just pause. Mm-hmm. Okay. So you have changes in cash. On change in cash, be equals. You pick what is in the CFO operating plus what is under investing there plus what is under financing, these three. Press enter. These are your changes or change in cash. Those will say cash and cash equivalent. Those accountants. Okay.
Director, just come again on change in cash.
You're just picking your net cash flows or from your cash flow statement. You are picking your cash flow from operating activities, cash flow from investing activities, and the cash from financing that is what you're picking. Okay. So so cash beginning. It will be what? You had 0 in there when you are starting. How much cash did you have? Cash at the beginning. You had 0.
Director, sorry, did we have a 30% contribution there?
30?
I'm trying to remember. I'm not having my spreadsheet. Did we have a 30% contribution to the project?
30%, yes, we had.
So that would be part of the cash at beginning, wouldn't it?
No, because you see what you have done here. The cash that you had under financing. That's a bit. That's right. Okay. So in the first year, cash beginning, you had 0. I was explaining in terms of the cash here that whatever invested in your capex, you are given the drawdowns, and the net effect is 0. So at the start of the year, you did not have any cash. Cash beginning, you had 0. Cash at the end, it will be basically this plus that. Okay. So cash at the end, it will be your cash at the beginning of the year. This will be like this. So cash at the end of the year, in year 1, that will be your cash beginning in year 2. So you have something like this. Now we can take these 2 numbers this side. Don't worry. So this is how it will be. You have changes in cash, which is these amounts. So you expect that by the end of the year, you have about 145, which is this. You're able to see it in here. But once we model dividends, all this is actually going to be wiped out. So don't worry. Do not worry. Okay. So down here, this will be your cash balances that will go into your balance sheet. Go up. So equals, you pick it up there, down there, sorry, under the cash end of year. Which is that? Go up to 2025, up to there. Okay. So on total assets, you are done. Have these numbers, they look crazy a bit, but we'll be able to correct that. So you then now go to your debt and equity. For that, let's do a sum for these numbers here. Enter. Take it this side. The principle here is that your total assets must balance your total liabilities. You should have zeros here. You should have zeros. That's how it is. So in year one, in terms of debt, in year zero, during in year zero, during construction, your debt, it was what? What was your debt during construction? It was 25,865, which is basically 30% of the 36 million. This is where you get your number. Don't know where you're getting it from. Which is basically your 30%, your 70%, sorry, of your 36 million, which is that. Then, your equity. Your equity, you got your input sheet, which is this 36 times your equity rate of 30% from your capital structure, which is this part. So 30%, it was actually been funded by, by equity, 70% by debt. So you have that 30%, which is that. So the first part balances. But then, when you come this side, you have these numbers there. Your debt, let me just check. Which is your ending balance, these ones here, for 15. So your ending balance, we can start from here. Then count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Or transpose, say equals, transpose. Go to your debt schedule. Pick this whole thing there. Close. Again, hold Control Shift Enter. For those that have latest Office, you just press Enter after you've done your transpose. And press there. The balance sheet is about to balance. Your equity, in this case, we didn't amortize the equity to be this. Press Enter and take it up to last year. Control R. That is your balance. Then you have a balanced balance sheet. This one now you call it check. It should always give you these zeros. So this is how you do it. But this is basic. Maybe basic, because the things now you have to model your dividends so that you remove all these things that are there, because you cannot have cash up to 135. Is it 145 cash? This cash of 145, part of it, most of it has to be provided for as dividends. So you have policies for your SPV. Maybe what would be there would be basically about 90% of your cash. You apply a cash sweep, 90% of the cash is actually swept and converted and given to the owners of the company in form of dividends. So you could do that when you come here. If you wanted to reduce this part. Exactly. Here on the dividends, we could sweep whatever cash we have there, sweep it as dividends. Then you reduce your cash. But I've done the 2 hours. I'll provide the dividends in here and a bit of some few complicated things just to show how bankable a financial model is supposed to be. And I'll send it to KGRTC and NIPA. There are a number of things that we should have included in here. Sensitivities, covenants with the lenders, which is basically your debt service coverage ratio, your project life cycle, your loan life cycle ratio, also those that actually hinge on those that the equity investors focus on, such as the equity internal rate of return. You would have put it in there. You would have put your theoretical NPV, your project IRR. This is why this course is very, very expensive. It's very, very expensive. But for now, I'll end here. And over to you, KGRTC and NIPA. Thank you.
Thank you. Thank you very much, Director. There is a question I saw from Mr. Is it Salim Henry? Have you had a look at it? I think you answered.
I must have responded.
Yeah, Mr. Salim, how are you with that question?
Or do you have a list of preferred consultants we could work with on our projects?
I think that's the only one because he didn't answer on the other one.
We are in this together. As ZESCO, we could still help you to just make your things bankable. I think that is what we have started doing now. Because as long as it is not in our best interest to let you take a document that is not bankable. That is what we're doing at first, but I think it is not in the best interest of the nation. So we can still help you towards your pursuit of excellence and going to bankability. So in terms of bankability, I think we have a team here that can still help you.
Thank you, Director.
Mm.
We appreciate it.
So thank you.
Yes, thank
you.
you,
And over to you.
Maybe I'll use my hands alone if others can do. I think a clap for Director is worth it.
Director,
I like your statement.
Director, thank you. I was following you with this, Director. Thank you.
Yeah.
Thank you.
Just a question.
Mm.
Yes, you can
Are we able to access them on YouTube, or how can we access them so that we can refresh our minds? Some of us with no accounting background.
Yes, like for the last lecture, I just posted it this afternoon. It's on my YouTube channel, but it's there.
Even this one will be posted?
Mm.
Okay. What channel is that? You missed that?
That's my name. Just check that those names. Go on YouTube,
Okay.
you'll find it.
Thank you.
Yeah, thanks, Jonathan.
But also, we shared the same information in the WhatsApp group. And even this recording will also be shared in the WhatsApp group as well.
Thank you.
Engineer,
Thank
are you
We've
done?
We've done the clapping, Prof. I think I'm overwhelmed. I'm very happy. That's my personal feedback. This program has changed my life, personal life, actually.
Engineer, sorry, just a quick one. I know us
Yes.
latecomers. I think Director Kapepe indicated to us that he's going to show us how to come up with a tariff. I don't know if that part has been covered.
No.
Sure.
The tariff obviously there now is you have to go to convenience, you have to go to equity internal rate of return, you have your target, meaning that you have to model all those things. So
thank you.
yeah.
So, Director,
you pay small, you get small.
Are you going to share any information covering the same?
I think when he finishes the model, that's when we can come to that. Yes.
I include all those small things, but now I'm not entitled to train you further than this. You talk to NEPA and KGRTC.
No, we
Director, we hear you.
Prof,
Okay.
I think the floor is yours. You can close this session. Thank you
Okay,
very
thank you
much.
very much.
Just one question for Director Kapepe. So in terms of trying to pitch up these models to the potential financing and whatever. So any insights into how we can actually pitch up for such?
I can't get your Martin.
Yes, right. So I'm saying in terms of trying to now pitch up the financial models to potential equity partners and the financials. Are there any insights would probably provide at this stage? Any insights on the negotiation side of things as a developer, basically?
Christopher, maybe you can just amplify what Martin is saying. I can't exactly get what he's saying.
Okay, so what he's saying is there any insights once you have the financial model on how to approach the financiers, let's say the DFI or even equity providers?
Yeah, so what ideally happens is that once you are done with your bankable financial model and you are approaching, say, Proparco, FDB, they'll definitely ask for your PPA, they'll ask for your grid impact study, they'll ask for all these subsidiary documents and also for the financial model. What others do, the results from the financial model, they'll put it in a PowerPoint. Just some few slides, just for pitching purposes. But the financiers also ask for the financial model and test whether it is bankable or whether the project is bankable.
Okay, I hope that is
and
answered
this is
the
what
question.
we are saying, Martin, that this
Yes,
financial model.
that's okay, very clear.
Yeah. So what we are saying is that these financial models, you start from version 1 and you find yourself at version 92 because other stakeholders and investors are actually looking at the models. And usually what happens is that once you are done with the financial model, you have to actually give it to an independent model auditing team, company, so that they put a stamp of approval. And the financial model, once you are done with it, maybe this is a process that I have never mentioned. Once you are done with it, those that want it to invest in your project, either debt or equity, they'll do a DD, due diligence on your financial model. So all the numbers you have put in there, they'll have to actually check, and they'll physically come. Check on irradiation or isolation. They'll check on all these other things that you're actually showing. They will need to have evidence on your simulations, whether you're using your P50 or P90. They'll need to actually check that data. All the numbers, they'll have to come through to ensure that the numbers that are in there are not exaggerated or they are not dummy numbers. If you're talking about withholding tax, they'll have to actually check, is it true it's 15%? And all that. So that the financial model that you're going to have and the numbers that are in there have been checked by that auditing, model auditing boutique. They call themselves boutiques. Okay.
Okay.
Thanks,
Back to you,
Director.
Prof.
That's very clear. Thank you so much, Director.
Thanks, Martin.
Okay, colleagues, as the training mentioned, these are fundamentals. And what is key is for us to understand and appreciate the fundamentals. Once we know the fundamentals, at least we know where to start from. And once we dive into details, you can go up to hundreds version. This is maybe version 0.0001. So meaning that there are a lot of other versions before we can even come to one. And we have been assured that at least we'll get a 0.01 version and we'll share with you so that you have an idea. The same way I've shared a template PPA so that you at least can look at how the PPA looks like. Most of it is just English. But what is key for you to even understand that PPA is what we are doing to understand the financial model. Because without that, it becomes just the English and it becomes difficult for you to appreciate it. So soon we will see some advert which is trying to call you to come for another training, looking now at the whole entire process from EIA up EPC. Because the PPA comes at the end when you are trying to do now the financial closures. Yes, so you'll see advert coming. So don't relent, and we are in this together. And the president mentioned that by the end of this year, we should have 1,000 megawatts of power from solar. That will not come from dreams or prayers, but that will come from planning and reaching financial closures. And this is the one way in which we can reach the financial closure, having a bankable financial model. I think we need to clap again to Director Kapepe for being selfless and setting his hours to be with us. It's not easy. He's a busy person, as you can see. He's in his office trying to solve national issues, but he has to take off at least 2 hours from his busy schedule to be with us. So please, let's make sure that we appreciate this little time and we'll share whatever information will come through, and let's make sure that we continue learning. This is not the end. Let's continue learning so that we are able to improve on our bankability of our financial model. So thank you very much, and have a good weekend. Thank you.
Thank you. Thank you. Thank you.
Thank you so
Thank
much.
you.
Thank you. Thank you.
Thank you.
Thank you.